Hello and welcome to the Waterfront second quarter market update. My name is Mike Shields, Senior Director and Financial Advisor here at Waterfront. We'd like to thank you all for joining us today. It looks like we have a record number of attendees, so we love that you guys are taking advantage. Listen to this, hopefully you enjoy it, get as much out of it as we enjoy putting it on. Just a couple of housekeeping items. We're going to try to limit this to 30 minutes today, and then after that we'll have Q&A. If you would like to submit a question, at the bottom of your screen, you should see a chat icon. You can click on that, box will pop up and you can type questions in, and we will try to address those at the end of the meeting. Also, just make sure that your line is on mute. I believe we've muted everybody as they came in. Also, if you'd like to turn your video off, you're more than welcome to do that if you don't want everybody seeing into your house. So as far as the slides and the recording, we're going to be posting these to our website and the YouTube channel probably by tomorrow. So if you'd like a copy, you didn't get to hear it all, or you want to share this with somebody, you can go to waterfrontadvisors.com, go to our news and events page, or just go to YouTube and type in Waterfront Advisors. It should be the first one listed by tomorrow. So as you all know and have seen in the market, there's a lot of issues causing volatility and uncertainty in the markets. Those range from inflation, interest rates, COVID lockdowns in Shanghai of 12 million people affecting supply chains, and Russia invading Ukraine, causing commodity prices to go up and European stocks to go down. So what does all this mean for you as an investor? And what is our outlook going forward now that we have this information? To get you up to speed, we've got our Chief Investment Officer, Chris Harrington, and Portfolio Manager, Matt Hekman. Gentlemen, I'm going to let you take it away.
Great. Thanks, Mike. And thank you again for attending. And I just reiterate something Mike said, please do put your questions in the chat. We want this to be helpful to you, and your questions help direct us in the topics that you find most relevant and interesting. So with that, I'll kick us off. Turn to the first slide. As you probably are well aware and have felt, growth is slowing. I provided the line chart on the right-hand side of that chart just to give you some perspective of where we've been for the last 2 years, which is phenomenal growth coming off of the COVID-19 pandemic of 2020. And naturally, growth is slowing. On the left-hand side of that slide, I've provided you with the consensus outlook for GDP growth based on a survey that Bloomberg did in early April. There were 56 economists that were surveyed, and you can see that starting in the first quarter of 2022, GDP growth on a year-over-year basis is expected to go from 4% to roughly 2% by the end of this year. There are a lot of reasons for that, a lot of drivers that are impacting that. We're going to talk about some of that going forward. Some of you may know that this morning the Bureau of Economic Analysis published the first quarter preliminary GDP reading, and it was actually negative. It was negative 1.4%. However, if you back out net exports and inventories, underlying growth was roughly 4% or in line with consensus forecasts. Encouragingly, if you peel back the data a little further, real final sales to consumers increased 2.6% in the first quarter, which is actually an acceleration from Q4's level of 1.7%, and just indicative, even in the slowing environment, of a very strong US consumer and an outlook for continuing growth. Now, growth is cyclical and growth rates are volatile. They tend to move over time. The fact that economic growth is slowing itself isn't terribly troubling. What makes this a little more concerning is the next chart, which is inflation. And as you are obviously, again, probably well aware, inflation rates are historically elevated. I've given you a chart on the right-hand side of that slide that you're probably familiar with, but it dates back to the 1950s. And it shows that over the last 12 months, we've experienced a rate of inflation that historically is very unusual and incredibly elevated. The drivers of that, Chris and I have spent a fair amount of time discussing in previous calls that we've done already earlier this year. And so I don't want to get into too much detail here, but just to recap, and for the benefit of those who weren't able to listen to those calls, fiscal policy and monetary stimulus has been profligate, is probably the best word to use to describe it, over the course of the last 2 years in response to the pandemic. In addition, because of the pandemic, supply chains have been disrupted, and that's created a scarcity of raw materials as well as key products. It shows up in all kinds of consumer goods, from cars to home goods, and even to the items you see stocked on grocery stores. That's contributed to inflation. And then finally, as Mike mentioned in his introduction, unfortunately, Russia's invasion of Ukraine has only aggravated an already difficult situation. That area of the world is rich in commodities, in ag commodities, in energy commodities, and also in a number of key metals. All of that has conspired to create an environment where inflation is incredibly high. And as a result, central bankers here in the US and around the world need to respond. If you turn forward to the next chart, you can see that interest rates have started to move higher and are expected to move meaningfully higher. On the left-hand side of that chart, I've given you the consensus forecast, again, based on a Bloomberg survey of about 62 economists conducted earlier this month, of their expectations of what the upper bound of the Fed funds rate is likely to be by quarter. And you can see by the fourth quarter of this year, the consensus estimate is forecasting roughly 180 basis points of interest rate increases from the current level of 0.5%. That level of interest rate hike has created a lot of the volatility that we're seeing in risk assets, and has created an environment in the fixed income markets that's relatively unusual. And I've depicted this on the right-hand side of your screen with a chart that shows the yield curve. Quite simply, the yield curve just compares short-term rates to long-term rates. And generally speaking, in normal economic times, long-term rates are higher than short-term rates, and it creates a positive slope to the interest rate curve structure. In periods of economic concern, long-term rates decline to a point where short-term rates are actually higher than long-term rates, and that's called an inversion of the yield curve. And that just happened. So March 31st to April 4th, for a period of 3 trading days, short-term interest rates were were higher than long-term interest rates, using the 2-year Treasury and the 10-year Treasury. That's shown on your chart on the right-hand side of your slide. As you look back over history, that relationship is unusual, and it typically happens in anticipation of a significant economic contraction or a recession. You can also notice by looking at the chart that you can barely see the inversion on the chart. It was 3 business days. The prior inversion, late in 2019, was 8 business days. And if you go back to curve inversions previous to that, in the middle of the 2000s, the 2005 to 2007 time period, you can see the duration of the inversion lasted months and even years, and was deeper than what we've just experienced. And again, similarly in the late 90s and in the late 80s. And so I think the message from the fixed income markets is a warning signal or a warning indication to the Federal Reserve to say, hey, if the pace of interest rate hikes that you're leading us to believe are probable, the impact on the outlook for growth is problematic. I think at this point, if you looked at the current consensus of the probability of recession, we're currently right around 25%. And it fits with the message of this chart, which is this is a significant risk. It isn't highly probable yet, but markets are concerned about it. And hence, we're seeing a lot of volatility in risk assets. One other point I wanted to make as you look at this chart, the yield curve inversion historically has typically led an economic recession by about 15 months. So if that pattern held true, this inversion happened late March, early April. The onset of recession would most likely happen in the middle of 2023, next year. In addition, one incremental data point that I want to give you that's important is typically in the past, post-inversion, equity markets have performed relatively well. And I think largely that's a result of the fact that the Federal Reserve pays very close attention to the term structure, the yield curve, and responds to these messages from the fixed income market and reduces their hawkishness, which equity markets then respond positively to. One other indicator I wanted to show you, if you move forward to the next slide and spend a little bit of time talking about, is equity markets tend to make the news. It's what people are most focused on. There's more volatility. There's a lot of newsworthy data that's out there regarding equity markets. Fixed income markets don't get that same level of attention. And so I wanted to highlight for you what we're seeing in the fixed income space, which is a lot less dramatic than what we're seeing in equity markets. So on the top slide, what I'm showing you there is the extra yield that fixed income investors require from investment grade rated corporate issuers of debt. So if the 10-year treasury is about 2.8%, which it is roughly today, over time, credit investors require an extra 120 basis points for an equivalent maturity investment grade rated corporate bond. So 2.8 plus 120 basis points is about 4%. So an investment grade issuer with a 10-year bond would be required to pay 4%. The difference between that the 4% and the 2.8 is called the credit spread. And this chart is that credit spread relationship over time. And you can see over the long term, it's been relatively stable, and it tends to spike meaningfully during periods of economic recession, which are the shaded areas on your chart. It also, you'll notice, tends to start to widen, or that extra yield that fixed income investors require tends to increase leading into those economic recessions. Today, the credit spread on investment grade rated corporate debt is around 120 basis points, which is right in line with the 20-year average. Credit markets today are not as spooked by the outlook and not as worried about an imminent recession as what we're seeing in the news. I think that's notable. The chart below that is the exact same metric, only it's for high yield issuers. So these are companies with high debt loads. Typically the businesses are lower quality, less profitable. And the relationship continues to be the same. In recessions, these credit spreads tend to blow out far more dramatically, north of 1,000 basis points or 10%. And they obviously have an average spread to the treasury that's higher. But again, even for these highly levered companies, the fixed income market at this point is not indicative of a near-term, a high level of near-term concern. And I think that fits with what we showed you a chart earlier on the yield curve. It was a 3-day inversion, not a multi-month inversion. It was a shallow inversion. It wasn't a deep inversion. Markets are signaling that there is a heightened level of uncertainty to the outlook and a great deal of concern, but we're not yet at a point where the die has been cast and people are convinced that a negative outcome is the most probable. The last chart I'll show you is a chart on sentiment. Now, normally I would tell you sentiment is noise, but at its extremes, it can be very instructive. And as you may feel yourself, but certainly what you're seeing on CNBC and on newspapers, the level of pessimism is quite high. This is a chart of the American Association of Individual Investors that conducts a sentiment survey on a weekly basis, and it goes back to 1987. And you can see that the percent of survey respondents who responded that they were bullish about the outlook for the last 3 weeks was below 20%. So 80% of the folks are either bearish or neutral on the outlook. You can see by looking at the chart that that level of pessimism is historically unusual. The data point I would give you is the last 51 times that this has occurred, 88% of the time, equity markets have rebounded over the following 13 weeks, which is 1 calendar quarter. And on average, that advance has been about 8.9%. This fits with the old adage of being greedy when others are fearful. And so while, as I sum up, and prior to handing this over to Chris, while there are many reasons to be concerned, and the risk backdrop has shifted meaningfully over the last 6 months relative to the last 2 years that have been very, very positive for risk. The current setup, to me, presents some interesting opportunities. So with that, I'll turn it over to Chris for a more global perspective and his thoughts on the outlook and setup. Chris?
Sure. Good afternoon, everyone. We'll start with China. China's in the news a lot, and certainly is these days. Has a very volatile stock market. For those of you who can see on the right-hand side, you look at the MSCI China Index, and that index, if you look at some of those annual returns, you see a whole lot of volatility. I mean, you see sometimes 50% up, but then you see 20% down. And right now we're in a situation where we've had 2 straight 20% downs. 21 was over 20% down, and we're currently down over 20% 2022. What's driving some of that? Well, regulatory risk has definitely been a factor, and that played out last year. And this year, probably the biggest factor is COVID. COVID is still a problem in China. They had less effective vaccines, and they're still continuing with COVID zero policy. We see cities like Shanghai and Beijing locking down. It's problematic, and it's hurting economic activity. Some of the data points I have here speak to a very, very troubling economic situation, and the data is supposed to get worse in April as some of the effects of these lockdowns really play out. The other important thing with China is they've had a very modest monetary and fiscal response to COVID so far, nothing like the US, and certainly asset prices are somewhat dependent on those type of things. And we'll see if the response picks up, if they need to juice the economy a little bit more with some fiscal spending. As of now, there's a little bit moving into the economy, but it's a little bit of a tense situation. It definitely impacts us too, as we're looking for these supply chains to normalize. A lot of manufactured goods come out of China. We see our trade deficit is soaring to new highs. And so what happens there definitely impacts us from an inflation standpoint. So we are paying attention to China. Moving on to Europe. Europe actually started the year off great. Some of the economic numbers were really solid in January and even into February, and then it fell off a cliff. And the chart I'm showing you here is a German economic sentiment index, and you can see how it's steadily improving, and then just bam, just goes significantly in the other direction when the war started. Germany is particularly exposed to Russian fossil fuels. If and a lot of people are talking about if Russia were to shut off gas, what would the impact be on Germany? Well, the impact would probably be a recession, because it'd probably be over a 5% hit to growth, and they probably can't overcome that elsewhere. So it's meaningful and relevant, the war in Europe, but it's impacting countries differently. Some of the further Western Europe nations are not as relevant. I mean, they're not as exposed, I should say, to Russian gas and oil for that matter. But it does look actually like they may be on a path to also all stopping use of Russian oil. So that's actually in the news these past few days. The asset prices are pretty attractive in Europe. They really are, but for sentiment to improve and for a strong bid to occur on some of those stocks, we need to see some type of resolution to the war. So we're paying a lot of attention to that. One thing I will say, that Germany has always been the most difficult, is probably the word I'll put it, when it comes to European stimulus. They like to manage their budget very, very disciplined approach to spending in Germany. And so they've always been reluctant to have big, large fiscal stimulus in Europe. Well, considering the fact that they're the most exposed to the Russia dynamics when it comes to energy prices, maybe they'll be more open to stimulus. So I'm paying attention to see if we possibly get some extra stimulus coming from Europe as the year progresses. Some of the other emerging market nations, India is projected to have a pretty good year. Latin America is off to a great start, and a lot of that has to do with the war. It's a big benefit to some of them, and they're commodity-rich nations. Brazil, a lot of food production, a lot of materials. You get things like copper and some of those metals. You go to Chile. And a lot of these nations are actually positioned really well to benefit from the war. And so we've seen strong stock market returns in 2022, early part of the year in Latin America. Things look pretty good in Latin America. India, still projected this year to be the fastest growing large economy in the world, talking about over 8% growth. We'll see if that plays out. There's a couple of things that could impact that to the negative side, as in India, that's currently happening right now. Southeast Asia, big area, lots of population. They did have their growth forecast cut to about 5% by the World Bank recently. A lot of that has to do with food and energy costs. If you were to look at this map, and what I'm showing you is this is based on 2016 numbers, but things haven't changed significantly since then. The darker the country, the higher the percentage they need to spend on food. Look at the US. We are a blessed nation. We have low food costs. Our food costs of the CPI weighting are 14, maybe 15%, but that includes food away from home, which is about double food at home. Food at home is less than 10%, and we can substitute. You all can skip the Chipotle burritos and the eating out and just buy from the grocery store, and you'll be just fine. I mean, food may impact you a little bit, but you have that substitution potential. They don't have that in emerging markets. Their food costs are what they can get at the local market. And you look at Southeast Asia, look at the Philippines right there. I mean, there's a bright red, very problematic. You look at Indonesia, even China and India, it's all darker over there. And so food and energy costs are a bigger part of the consumption basket. And these are concerns. The Arab Spring from many years ago was started because of food costs. You look at Egypt right there. Egypt uses a lot of wheat. Well, wheat is about as impacted as anything right now. A lot of wheat comes from the Ukraine, Russia area. Then India was supposed to pick up the slack with wheat, but their country right now has extremely high temperatures, which is decimating the wheat crop. So, there's some of the global warming impacts that are impacting food as well. And so food costs are a problem, and we pay attention to emerging market nations and where that goes from here, but those are considerations we pay attention to. Getting back to the US, we are going to need this time is different dynamic. If you study historical data, when we've had close to about a year of real average hourly earnings being negative, that's your wage growth minus inflation, unemployment. Sounds good when it's down to 3.6%, but that's a lagging indicator. So usually when unemployment gets that low, you really need to have some people come in off the sidelines to keep the job market humming along, or some other dynamics in play. And then inflation is high. Usually when inflation is this high, it creates the recipe for a recession. So why can this time be different? Well, we've been in a very unique time period for the past few years. COVID has changed a lot of things. The government response has really created some interesting dynamics. So if there ever was a time for this time to be different, I would say we have a good shot at it right now, because of some of the peculiarities that have occurred over the past couple of years. But it's going to require inflation to come down. So how is inflation going to come down? Well, we still have two big issues, in my opinion. Material prices being impacted by the war. Supply chain, by the way, has improved quite a bit, and I'm paying attention to what's happening in China, but shipping rates from China to the US have dropped significantly. So that's a good sign, and some other dynamics are pointing to improved supply chain here in the US. Business confidence, though, we continue to see companies talking about raising prices. Well, that's problematic. If companies are so confident that they can just raise prices, it's going to create a difficult environment to get pricing down. What is going in our direction? Well, supply chain I just talked about is improving industrial production. Industrial production, when that picks up, that means more volume. Think autos here. Industrial production is really starting to pick up in autos, and that means more autos, and that means auto prices should stabilize, hopefully even contract a little bit. That would be a welcoming sign. You need more volume to get pricing down. Multifamily housing starts, another more volume dynamic. They're at record highs. They are putting up multifamily housing left and right. And so that impacts with a lag, but that's going to create an overhang for the rental markets. That'd be important. Rentals are a very important expense, high weighting in consumption baskets. And so if we were to see some relief in the rental market, that would be very nice to see. Automation, it's in play. In the GDP report this morning, there's still healthy corporations spending on things like IP and business equipment for automation. That's a trend. That's a secular trend that's going to continue to play out. You see it with even the local McDonald's starting to go with their automated ordering systems, and that's a trend that'll play out over this decade. Why are companies spending heavily on automation? Well, part of the reason is to lower the labor costs. So I think that's going to continue to play out. And then consumers. Consumers need to balk at higher prices. That's probably the most important dynamic to get inflation down. Businesses cannot be so confident that they can just throw out increased prices and consumers are just going to accept them. Right now they are, which is I have a slide I'm going to talk about next, which really plays into that factor. So what I'm showing you on the right is this is a little stale. It's the end of 2021, data through December of 21. It shows you what caused some of the inflation dynamics in the latter part of 2021. You can see the US, you have this big gray area. It's called other. In Europe, really you could dial it down to energy and food. A lot of other advanced nations dial it down to energy and food. US has this big other dynamic, which can be attributed to several things, but there's definitely more psychological inflation in the US. What is psychological inflation? Well, it's confidence. Confidence, businesses can raise prices and consumers are just going to accept them. The consumers develop the mindset that, well, prices always go up. So yeah, it stinks that this price is a little bit higher, but it's going to be higher next year. So what the heck? That dynamic is actually really playing out in the US in a big way. Consumers are not balking. So this is a really challenging dynamic because you see this, are consumers continuing to spend a good thing? And this is starting to raise left and right. Almost all the time, consumer spending is a good thing. Consumer spending more is a good thing. But you're starting to see some talk. Are consumers continuing to spend this much a good thing? Well, the argument that maybe it's not is they're just accepting any price that's thrown at them. And that's not going to change the inflation dynamic. That's a recipe for a disaster down the road when consumers really don't want to dip into their savings anymore. So I am very much paying attention to this dynamic, and it's odd to say this. Is consumer spending a bad thing? Businesses need their confidence broken. How is their confidence going to get broken? Well, hopefully it can be gradual, but you also have the dynamic where consumers need to teach them a lesson. And when is that going to occur? Inflation is the elephant in the room, but it's not the only obstacle to asset prices. Competition is actually more important. And we look at some of the corrections that have occurred in some of the higher growth stocks. It has nothing to do with inflation, maybe a little bit to do with the markets and inflation. It has to do with competition. Netflix is, you know, a good business, but it's not a great business. They still have to spend a lot and have competitors, and that realization occurred this year. And so you see a stock down over 50%. PayPal, it's kind of intriguing now, but PayPal, you know, when you look at it from the standpoint of last year, you know, were they going to be the only payment option for people? No, I mean, it's a competitive space. There's a lot of companies that can do payments. And then, so we saw the huge decline there. Meta, Facebook is actually having a nice rebound today, but you know, they've been hit by competition. And even some of the smaller ones, they're still big companies. You know, I put in a couple there, but you can actually get into the mid-cap growth space, and you see some really drastic moves. You're talking 80% plus declines when it turns out these companies really are not that impressive and they can't outcompete their peers. Teladoc, if anyone wants to look up that stock, it's another example. You can look at that this morning where, you know, what they do sounds cool. I mean, telemedicine, yeah, that's great. We got a pandemic going on, but then you get into the nuts and bolts of it. You know, anyone can do that. It's not that hard. Insurance companies are going to drive it, and they may, if it's really profitable, they'll just do it themselves type dynamic. So, I mean, you have a lot of that still in play in the markets. The stock prices are actually reasonable. If you know, a lot of these companies are actually already pricing in a recession. So there's some good buys out there, but overall in the broader markets, you know, if we do head into recessionary conditions, probably still a little bit elevated, but you know, not in an extreme sense, at least in my opinion. All right, so really quick, we've seen a backup in treasury rates that is making corporate bonds have some appeal. I don't think they have a whole lot of appeal. The rates are in a reasonable spot now, so it makes sense to increase your allocation a little bit to corporate bonds. The opportunity we really saw is in municipal bonds, because you could see municipal bonds that are tax-free trading with yields similar to the corporate bonds. And obviously, you know, when you divide that by 0.4 or 0.6 or whatever you're going to divide it by the tax rates, you get a taxable equivalent basis, you could get up near 7%, where corporate bonds aren't anywhere close to that. Some of the bonds we've been buying in municipal land recently are just incredible deals. So municipals have been an opportunity here. Corporates are, they're okay. Makes sense to increase allocation a little bit, but I don't think it's anything you want to, you know, extremely overweight. You know, and we mentioned down here, inflation needs to slow. It just has to. And how that inflation slows is really going to dictate how this year plays out. If there can be a, you know, strong increase in volumes, then maybe you can get a healthy way of inflation slowing where consumers hang in there. But that really remains to be seen. We still prefer some value stocks, near-term cash flows, even though growth stocks have sold off more in this market.
All right, guys, we've got a few questions here in from the chat box. So first one here, what adjustments will you be making to your portfolios in response to these most recent economic events?
Yeah, I'll start. So it's important to understand what direction the tide is going. In many different facets of life, markets is no different. And we've moved from a period of time, an extended period of time, multiple years, where the Fed has been swamping markets with liquidity. governments have been sending checks literally to consumers. And in that environment, being long risk makes a lot of sense. All of that's beginning to shift and change. Interest rates are going up, fiscal stimulus is being withdrawn. And so from a portfolio perspective, early in the year, I sat down and went through name by name and just did a risk assessment to try and discern which names I felt were most at risk to a change in the economic backdrop and make sure that I do my best to try and avoid significant impairments of capital, big declines in equity prices as a result of a change in the economic environment. As we moved through that time period, given the run-up in energy stocks, from a sector perspective, I have reduced my exposure to energy. We all hope that the current environment in Ukraine is transitory, that this war will end relatively soon, and that geopolitical risk is certainly embedded in crude oil prices and natural gas prices. And my hope, my anticipation is that that war will be resolved and that geopolitical risk premium will come out. And so energy has been a great place to be invested. We've definitely benefited from that as a firm for those invested in the waterfront equity and waterfront balance strategies. I just took the opportunity to shave off some of that overweight, and I invested it in areas of the market that are less sensitive to economic growth. Specifically, staples had been an overweight relative to the benchmark, which is the S&P 500. I added to that. Most recently added Kraft Heinz, a company you're probably very familiar with. And then I also went from an underweight position in utilities to an overweight position in the March time period. I added a company called the Southern Company, which is a utility in the southeastern portion of the US that has a positive regulatory environment and a growth kicker from a new nuclear power plant that hopefully will be coming online over the course of the next 18 months. And I'd say most recently, over the course of the last several weeks, we've seen, as Chris mentioned, a significant pullback in growth stocks. And so over the last couple of weeks, I spent a fair amount of time weeding through those names that have pulled back the 50, 60, 70% to try and discern if there's any of the baby being thrown out with the bathwater, to use that analogy, opportunities inside that group. Last week, I actually initiated a position in one of the stocks Chris highlighted, PayPal. I think it's a company that was massively a beneficiary of the growth in e-commerce as a result of the pandemic. Their growth is decelerating significantly. Their profitability, however, has been stable, and my expectation going forward is that competitively, their ability to outgrow e-commerce will prove durable, and their profitability will prove durable. It's a stock that used to trade at a dramatic premium to other stocks in the S&P 500. Today, it trades in line with an average company in the S&P 500, and I think its growth prospects and certainly its profitability is above average. And so that's what I do. I spend all my time trying to find opportunities like that, and my anticipation is, and my hope is that there will be more of those that I'll identify in the near future. But big picture from a portfolio construction perspective, both for the balanced and the equity funds, I'm being very careful about trying to manage risk and ensure that my exposure to economic growth in particular isn't outsized, and really narrow my focus and make sure I'm trying to find quality companies that have above average profitability with drivers that enable that to continue into the future, that can thrive even in downturns. The equities may pull back, but generally in downturns, these kind of companies expand their competitive advantage. They survive. They not only survive, they get even better relative to peers that have more leverage on their balance sheet or competitive advantage that isn't sustainable. And so these kind of companies tend to take market share and come out on the other side of a recession if and when that comes in an even stronger standpoint. And so taking the opportunity that may come, or being ready to take the opportunity that may come in the event that those stocks pull back to a meaningful amount, is something that I'm incrementally very focused on. Chris?
Yeah, well, it's kind of funny because I think Matt and I, we look at a lot of the same data, and I just tend to be, we agree on a lot, but I tend to be a little bit more bearish. But at the same time, that stuff I'm allocating to is the type of stuff that people say, well, why would you allocate that to that if you think a recession is coming? A lot of consumer discretionary, and I've been not going crazy, but increasing the allocation some consumer discretionary recently. That's really based on the fact that I think they're already pricing in a recession. And if you don't get one, they may have the ability to move significantly higher. And if stocks continue to move down, I think a lot of them have gotten hit so much that they were going to have a beta similar to the market, and they'll move down. They'll continue to move down, but you won't get that sort of high beta where they move down significantly more than the market. General Motors is one. You look at autos. There needs to be more. They definitely have a tailwind for production. Yes, pricing could be a headwind, but they continue to execute. It's a really challenging environment for autos and a lot of manufacturers. Their material prices, labor, supply chain, all that stuff's hitting them. And then you can still sort of reiterate your forecast, and you're trading at 6-7 times earnings in a tough environment. That to me is very attractive. And yes, maybe if the economy really rolls, you're going to get hit, and that 6 to 7 times earnings is a mirage, and it's more like 10 to 11. That would be in a shallow recession. If there's a deep recession, they'd get hit more than that, but it's still an incredible value. And even in bad times, to be trading maybe low double digits in an earnings multiple, that the earnings multiple of the S&P is closer to 20. And so you look at some of these companies, consumer discretionary, and they're just hard priced for a recession. Absolutely. I mean, there's a company called Brunswick that I did a tiny allocation to this morning. They're the leader in boats and boats engines. I mean, they dominate the space. They took share. They're putting people out of business. You use Brunswick and their Mercury engines if you're in boating. Who the heck is going to buy a boating stock if we're going into a recession? And I'm thinking that. I'm well aware of that. But at the same time, you have a dominant company that's trading 6-7 times earnings. So even if the market hangs in there, they have the ability to soar if we avoid a recession. And so I look at those risk reward situations. Home builders obviously are facing a big challenge with mortgage rates and pricing affordability. At the same time, there are secular dynamics in play. Well, if a recession comes, actually with home builders, you're probably going to see the 10-year drop, the rate drop, and some of those stocks may actually go significantly higher if the recession comes, because the stock market's looking forward to beyond the recession. So I am definitely adding to consumer discretionary, and they're going to be volatile. These stocks are volatile, and we'll see what happens. But my bet is that some of these stocks only go down with the market. If the market continues to go down, and if we get some stabilization, they can go up 2 times what the market goes up.
All right, well, that leads a nice segue into this next question here. With the rise in interest rates, how will that affect the housing market?
Should we switch it up, Chris? You want to go first on this one?
Sure. I mean, I am worried of the housing market. I think pricing is high compared to affordability. So, my strategy is I own one home builder, even though they're all priced at about 5 times earnings, which is very low. If they can hang in there and they can keep their earnings power somewhat close to what it is currently. I think the secular dynamics that are created with the shortage of housing and some of those dynamics will keep housing okay. You still hear about people paying cash for housing, and there's still demand out there. Whether that hits a wall and collapses, paying attention to that. But the bet I'm making is that the growth stalls, but you don't see a significant contraction in housing. And if housing hangs in there, not as a growth story, but sort of hangs in there as sort of a stable story, the stock prices are so low that the stock prices actually can work even if there's not much growth or zero growth.
Yeah, I would agree. In most respects, housing likely will slow in response to mortgage rates that are over 5% today. I would, though, highlight that one of the biggest issues in the housing market is a lack of housing supply. And that is in the end, it's supply and demand that drives pricing. And that lack of supply is a significant headwind. And a significant issue. We need to build more homes, and the affordability of those homes is at risk currently. With mortgage rates over 5.5% today, that's roughly a 250 basis point spread to the U.S. Treasury. On average over time, that's been closer to 150 basis points. And so I do think there's room for mortgage rates to absorb increases in Treasury rates without making parallel moves higher, such that mortgage rates don't go too much higher than the level they're at right now, which will help on the affordability side. But we need wage growth to help consumers get into a place where housing is affordable. We need more supply, new housing units being built. And as Chris mentioned earlier in this conversation, the build out of multifamily units also will take off some pressure on the rental side of the market, which hopefully creates some opportunities for those folks that are looking for homes to move into. But it feeds into and is a part of this bigger conversation, which is with interest rates increasing, it's a totally different environment than the one we've been in for the last 2 years and really the last decade plus. And it creates new challenges and heightened level of uncertainty. And whether it's housing or any of these other assets, equity markets, fixed income markets, it's likely to translate into heightened volatility over any kind of reasonable investment time horizon, say the next 2 years.
All right. Next question here from the chat. What is worse in the Fed's view, the current inflation rate or a recession?
People can, that's sliced and diced. Whoever wants to, people can say either one and put some good data behind it. I think inflation, from their talk, I believe they want to get this inflation rate down, even if it creates a recession. That's what I think.
Yeah, I think inflation is the issue. So the Fed is being as vocal and as hawkish as they are right now because of the level of inflation. If you recall the chart I showed you, over the last 70 years, inflation is abnormally high. Their long-term target is 2%, we're at 8%. They have two mandates, employment and inflation. And so they need to move policy in a way that brings that inflation rate lower. Again, as I showed you on that chart, encouragingly, the consensus forecast is for that inflation rate to decline. The pace at which it declines is incredibly important to the outlook. It's incredibly important to how the Fed will move interest rates, the pace at which they'll increase interest rates. And I think it's important in terms of how they speak, how they communicate their outlook and their expectation for rates going into the future, which will have an impact on risk assets. So I would say I agree with Chris, inflation is the key issue.
All right. One last one here before we run out of time. Is Netflix an example of consumers balking at higher prices?
It is in my household. We count us as one of those families that cut Netflix. I don't know. Every time, we don't watch a lot of the shows. I hear they're good, but we have a lot going on. And when we do watch a family movie, we end up paying for it or renting it. So what are we getting? And then I get 3 other subscriptions for the price of Netflix. If you really like their content, obviously it's worth it. It's not too much, but if you don't have time for their content, I think it's priced high.
Yeah, and I'd say that's a really good question, insightful question. I would say it's a blend of price and competition. So if you think back 10 years ago, everybody paid triple digits, $130 a month to a cable company for 300 channels, of which you watched 20. And at the time, the big debate was, why don't they allow us just to go a la carte and pay for the channels we want? Part of the streaming world came about, part of the reason for why the streaming world came about was it allowed consumers to choose the content they wanted to consume, or at least it gave them more choice. And it also was significantly cheaper than the $130 they were sending to a cable company. The problem is, in addition to Netflix, which was the early mover, had the first mover advantage, now you have Peacock, you have Disney Plus, you have Amazon Prime, all of which charge similar amounts. And by the time you add up all of those incremental opportunities, you're paying, if you bought all of them, you're paying $135 a month again. We're kind of back to the exact same problem. And so I would just say the proliferation of competitive offerings, as well as the pricing environment for each of them, finally coupled with the incremental opportunity that consumers have to get out and spend time in ways other than consuming media content. So the ability to go watch a live show, spend money on going to a concert, the ability to go to sporting events, meet up with friends at restaurants and bars. It just is, the amount of time allocated to consuming media content is less because we have more opportunity to spend time in other ways. All of that, I think, is conspiring to create an environment where Netflix is seeing pressure on growth.
All right. Well, thank you guys. That was a lot of great information. If there was any other questions, we'll take a look at them, see if we can reach out to you guys directly and answer those. Once again, thanks for all the information. I know you guys put a lot of time and energy into this. It was great. As I listened to it, I sit back and think all this information means different things to different investors at different stages of life. If you're a young investor and accumulating right now, you should welcome this choppiness, this volatility, and/or a recession later with open arms, because you're buying every 2 weeks. And right now, you're buying stuff at 10 to 15% discounts than you could on January 1st. However, if you're approaching retirement or in retirement, the name of the game should be focusing on having plenty of cash on hand and have a sufficient cash flow. Also, rising interest rates may help that cash flow here down the road. So with that being said, I think really the most important thing is to make sure you're setting up your annual reviews with your advisors, making sure that your risk, your asset allocation is matching your goals. Also, something while everybody's in the mode of taxes and doing annual reviews, check your beneficiaries on not just your accounts you have with us, but insurance policies, 401ks. It's amazing how many people forget to change those due to deaths, divorces, things of that nature. And then also trust documents. If you guys have a trust document, every 3 to 5 years, it's good to revisit those just to see if anything's changed in life. Lastly, we've got an upcoming event next Wednesday, May 4th. We're going to be celebrating Cinco de Mayo one day early with a taco truck here at the office. For any of you wondering, yes, we're value investors, and it was more cost effective to get a taco truck on May 4th instead of May 5th. So if you haven't RSVP'd to that yet and you'd like to join us, please do so, so that way we can plan accordingly. Also, just as a reminder, I mentioned this earlier, I don't know if everybody was on right at the beginning, but this presentation and the slides will be on our website and the YouTube channel. So if you're wanting to, if you missed some or couldn't stick through all the whole hour we went through, you can go back and watch that, or if you want to share it with friends. Other than that, thank you again for joining us, and we look forward to seeing you soon.